Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer in screen. Everything in this video is general in nature. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. We now have the path locked in, and I think we really need to look at it from the point of view that it is a bit hawkish in terms of where we stand. We had been discussing the idea that the Fed could raise rates 0.25% for the meetings that they've got coming up, but I don't think I expected them to be doing it at every single meeting before the end of next year or the end of this year. So a further 6 rate hikes in 2022 to go with the one that was expected last week, and that's what we got. That would mean that the federal funds rate will have a range of 1.75 to 2% for Christmas and a midpoint of 1.875%. That is quick in any shape or form and quite steep. And then a further 3 next year, taking it all the way up to 2.75%. That's hard to see that happening, and without really walking the tightrope of how do you get inflation down and keep growth going. Now, the next take out of the Fed was that clearly they believe that the economy is strong enough and could even flourish under higher rates. All well and good to say that. Whether or not it happens in reality is a different story. FX off the back of it moved like you'd initially expected. It jumped up. But what probably might have been lost a little bit, but I think is what's coming down to the FX world, is the balance sheet. Powell, in his commentary, in his press conference afterwards, highlighted that they are moving, and this is his words, in an extremely well-established direction with the balance sheet. People take this, having seen Fed speak over the last couple of weeks, around the idea that they're going to actually trim it. They're going to slim the balance sheet down over the coming period. Some even believe as soon as May. And if you've had a known buyer go to a known seller with the amount that they've been buying over the last 2 to 3 years, that's a lot of USD to start flying back into the market. And that, I think, is what explains why Dixie, when you have a look at it, initially popped and then fell away. But then it's against the currencies that matter. Look at Euro dollar, look at cable, look also at what happened in Aussie dollar and Euro CAD. They're all moving in a way that suggests that that US dollar story has now got a pressure from the fact that the biggest buyer has become the biggest seller. The only one that bucked the trend, as it should, is to some extent, is dollar yen. Dollar yen is still following the trend that has been there for quite a while now, which is following US interest rates. So as rates went up off the back of that stuff from the Fed, you actually saw dollar yen go from 118 into 119. It's making levels you haven't seen since 2016. It's eased back, I understand that, but this is a currency pair that at the start of last year was in the low 100s. It then got up to 110, smashed through 110, and we're now talking about 118, and there's no signs of it slowing down. And that really strong correlation is one of the reasons why dollar yen is still one of the better pairs in the current market.